Meantime, the federal debt load snowballing in recent months, adding about $1 trillion every 100 days and currently sitting near $34.5 trillion in total. The surge raising concerns about higher rates and lower growth in the long run, which our next guest says could make capital more sparse, cut into the number of U.S. debt buyers.
The world is in debt to the tune of $315 trillion and counting.
We haven't seen this kind of debt since the Napoleonic Wars. We're getting close to 100% of the global GDP.
The United States plans to use inflation to reduce its debt burden. The wealthy employ the same strategy, and the best part is that once you understand their methods, you can do the same. Currently, the U.S. government has over $34 trillion in debt, but this figure alone is not very meaningful. To put it into perspective, the government pays approximately $1.2 trillion annually just to service this debt. Servicing debt means paying the interest portion of the debt. To maintain the same level of debt without reducing or increasing it, the government must pay $1.2 trillion in interest each year. However, the government has to borrow more to cover this $1.2 trillion, causing the national debt to increase. Consequently, next year, the cost to service the debt is expected to rise to $1.7 trillion. This is problematic when considering the U.S. total tax revenue, which is around $4.5 trillion. But soon, every dollar collected in taxes will go towards servicing the debt, leaving no funds for other expenditures, which will require additional borrowing. This creates an endless cycle of borrowing to pay debt, leading to insolvency and potential default. For an individual, if 100% of their income goes to interest payments on debt, lenders would eventually stop offering loans, leading to default. However, the U.S. government is not a typical borrower and can choose to resolve this issue. The U.S. has been in this situation before, and examining past responses can offer insights. Gross domestic product, GDP, measures the size of the economy. To assess the government's leverage, compare their tax base, GDP, to their debt burden. Currently, the debt to GDP ratio is around 120%, which is high but not unprecedented. The last similar situation occurred in the 1940s. From the 1940s to the 1980s, the U.S. government reduced its debt to GDP ratio through inflation, with both inflation and interest rates rising. The economy grew relative to the debt. Conversely, from 1980 to 2020, the government increased its leverage as inflation and interest rates fell, allowing for greater debt without higher costs. If interest rates decrease from 10% to 5%, the government can double its debt while maintaining the same monthly payments. For the past 40 years, as interest rates have fallen and the economy has grown, the U.S. government has accumulated more and more debt, managing to afford it up until now. However, they've reached a peak again at a 120% debt to GDP ratio. If we project this trend forward from around 2020 to 2060, we might see a period similar to the 1940s through the 1980s, characterized by deleveraging, where the government reduces its debt relative to GDP through inflation. During the 1940s, the Federal Reserve engaged in yield curve control, keeping interest rates on government debt artificially low by purchasing as many bonds as necessary to maintain those rates. This allowed the government to borrow extensively at low rates, effectively creating money. The government spent this money into the economy, especially on war efforts, driving up prices and leading to high inflation, with real interest rates becoming steeply negative. Additionally, there was a prolonged period of rising inflation and interest rates. The 10-year government treasury rate increased over about 40 years, culminating in the 1970s with the abandonment of the gold standard, resulting in even higher inflation and interest rates as the government spent more money without the constraints of the gold standard. The phase from 1980 onwards was the opposite, marked by increasing leverage. The debt to GDP ratio rose, inflation rates fell, and interest rates declined, enabling both the economy and the government to accumulate more debt affordably. This environment informed common investment advice such as dollar cost averaging into the S&P 500, which is based on data from this period. However, this strategy may not be effective in the next phase of the debt cycle. Instead, it would be prudent to consider strategies that were successful during the previous deleveraging period. Given what we know about the 1940s and the contrasting period starting in the 1980s, the current approach will likely involve keeping interest rates higher to combat inflation. Federal Reserve Chair Jerome Powell has consistently stated that rate cuts will only occur if inflation rates decrease sufficiently. Despite market expectations at the end of 2023 for imminent rate cuts, Powell has reiterated that inflation has not yet reached the desired level, and rates will remain high until it does. Now, if you like this video, check out this next video right here.